Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Donald Trump's creative suggestion: the U.S. president's aides seek to tone down his proposal of a Gaza takeover after global condemnation. Beijing takes fresh steps in response to U.S. tariffs, calling for trade talks at the WTO. The U.S. Postal Service, meanwhile, reverses its decision to halt shipments from China and Hong Kong. And Qualcomm and ARM fall in late trading. Slowing smartphone growth concerns hit Qualcomm, while a tepid revenue forecast hurts ARM shares. It's just gone 8 a.m. across the Emirates. I'm Johanna Victorino in Dubai, getting you up to speed on the markets this morning. Second positive day in the row for the S&P, so rebounding from some of that down performance that we had on Monday. But since then, we are leaning towards the green. Today, futures are up about 0.8%. And a lot of those so-called tariff trades have actually started to be unwound in global markets in the last couple of sessions. So 10-year yields actually rallied 9 basis points yesterday. Really strong rally. Remember, we've been talking about 4.5% as sort of being that line in the sand, a support level for 10-year yields. Broke through that yesterday on the weaker services print out of the U.S. The dollar also today slightly firmer, but the theme for the USD, again, has been one of weakness and declines the last few sessions, trading at the lowest level in the past 5 days. So a lot of those macro Trump trades have been priced out of the market in the last couple of sessions. Brent also in focus today, up about 0.1%, but we did fall as much as 2% in trading yesterday, and this on a build-up of stockpiles coming out of the U.S. So again, fundamentals beginning to trump some of the geopolitical concerns that we have been talking about. Switching over, I also just want to point out today is a central bank meeting day. We've got the Bank of England coming up. The market is 90% pricing in a 25 basis point rate cut, but this is a really good chart because it just shows the two twin focuses of the Bank of England. On growth, on one hand, you've got growth stagnating. Basically, the UK economy isn't really growing. It's growing at around 0%, so not growing at all. And at the same time, we have seen a small acceleration in inflation towards the end of last year. Services inflation still continues to put upward pressure on the UK economy, even though the prints have started to show some signs of deceleration. But these are the two aspects that the Bank of England have to weigh when thinking about the path ahead for interest rate policy. So I'll park that there, and we'll talk more about the Bank of England later with Lizzie Burden. But for now, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, and I guess a more positive reaction today for some of these markets.
Yeah, Jumana, I mean, you look at the price action this week, volatility has really been the name of the game. Earlier, we saw on Monday stocks coming under pressure given those tariff concerns. So today, it's that continued calm or semblance of it that's returning. And we're seeing stocks in Asia mostly higher, including Chinese shares. Worth noting, the U.S. Postal Service has reversed an earlier decision to halt China shipments. You're looking at the Nikkei also tracking Wall Street gains despite the climb in the Japanese currency amid hawkish BOJ commentary. One of the stocks that we're focusing on in Japan as well is that of Nissan, as sources tell Bloomberg that it's looking for a new partner with that deal with Honda set to collapse. And according to sources, Nissan is set to prefer a partner from the US and from the tech sector. So among the things that we're watching in the Asia Pacific today, Jumana.
Avril, thank you so much for that overview. Aides to President Donald Trump are playing down his proposal to, quote, own Gaza. That's after the U.S. president suggested his country should take over and redevelop the coastal Palestinian territory while displacing its residents to neighboring Egypt and Jordan. White House Press Secretary Caroline Leavitt calls it an out-of-the-box idea.
The president has not committed to putting boots on the ground in Gaza.
Is the U.S. prepared to remove Palestinians from Gaza by force?
The president is prepared to rebuild Gaza for Palestinians and all people in the region.
Why not rule out the idea of committing U.S. troops? This has been a long-standing argument that the president has made really over the last decade or so, talking about endless wars and not something the U.S. wants. Why not rule out troops?
Because I think the president is very good when he's making deals and negotiating, not to rule out anything, because he wants to preserve that leverage in negotiations.
The announcement was criticized by Saudi Arabia, Egypt and France, while Egyptian President Abdel Fattah el-Sisi said his country plans to quickly roll out efforts to reconstruct Gaza. So for more on this and the fallout, let's bring in Dana Khrish, Bloomberg's UAE bureau chief. So quite clearly now, Trump's aides within the U.S. administration are dialing back on the comments. We just heard from the press secretary there, and she was saying there are no plans at all to send U.S. troops to the Gaza Strip. What do we make of this slow rollback?
Exactly. They are toning it down. And we saw her saying, tax dollars are not going to go into the deployment of U.S. troops in Gaza. I think what they're trying to suggest is that this is Trump's way to raise the bar really high, a ploy to probably force some concessions on countries that have been very resistant to any idea of displacing Palestinians. I think he might want some flexibility, and maybe this is the way to get it, he thinks, is to have this kind of a shock and awe thing about the U.S. taking over the entire Gaza Strip. Now, we saw a lot of reactions yesterday from the region, specifically from U.S. allies, right? Jordan, Egypt, and Saudi Arabia. And these three all have balancing acts, right? You see, Jordan and Egypt rely heavily on U.S. aid, especially Jordan. Most of that U.S. aid that comes annually plugs its budget deficit. It has a population that's also displaced Palestinians, and they fear kind of resistance, they fear instability, they fear also, the fear is that Iran might actually take advantage of this, might rile the crowds to again say we need to resist or, more terrorist acts.
But I guess one of the aspects of yesterday is it did cast light on the situation of so many Palestinians living in the Gaza Strip who don't have anywhere to live right now. And so how has this pushed along the discussions vis-a-vis the reconstruction efforts and the temporary housing that hundreds of thousands of Palestinians will need in the coming years?
So we're in the first phase of the ceasefire. We still have a second phase. And the third phase is apparently what is called the reconstruction, right? They haven't even pledged money. None of the Gulf countries that need to put in money for Gaza have discussed this. We don't know what the future will hold, right, in terms of Palestinian Authority, in terms of Hamas. Are they going to be a joint governance to this? So it's very not clear about the future of Gaza. And maybe this is what they think the third phase would hold, is that when you get to that third phase, you bring back the hostages. And we saw Israelis also yesterday, right, you have the far right who thought this was, a dream come true for them. This is part or aligns with their idea of clearing out Gaza, clearing out Hamas, primarily. But then you have centrists and others saying, okay, but we need the hostages. They don't want this to obstruct the ceasefire agreement and the details in this, and bring back the hostages and really just stabilize Gaza for them so they won't have a repeat of the October 7th
the backdrop
attacks.
to all of this is the ceasefire is still very tenuous anyway to begin with. Dana, thank you so much for the reporting. Dana Khrish, Bloomberg's UAE bureau chief. Let's continue the conversation with Hasan Alhasan, senior fellow for Middle East policy at the International Institute for Strategic Studies. Good to have you with us. I was just speaking to Dana about the fact that the U.S. administration's aides are coming out now to dial back some of the language that the president used yesterday and not implying at all that they're going to send troops at any point in the future to the Gaza Strip. Yet I do wonder whether, to a certain extent, the damage has been done with some of the U.S.'s closest allies within the region, because we got a really strong rebuke out of all of these Arab states, Egypt, Jordan, and Saudi Arabia.
Yes, hi, Jemana. It's good to be with you. No, we have been seeing a degree of creative reinterpretation by the U.S. Secretary of State, Marco Rubio, by the U.S. Press Secretary as well, trying to tone down and roll back some of Donald Trump's comments. But I think, listening to his press conference with Benjamin Netanyahu, he was explicit. He was very crystal clear, really, about what his intentions were in Gaza. The idea of displacing Gazans out of the Strip to neighboring countries, specifically Egypt and Jordan, the U.S. owning the Strip. Now, we have to be very clear about the terminology, because what that amounts to essentially is the ethnic cleansing of Gaza. And if we were to take Trump's words literally about U.S. ownership of Gaza, then that would obviously be an annexation the Strip. And all of this would obviously be a gross violation of international law. I don't think this is something that any of the regional countries, including those that depend on U.S. aid, including longstanding U.S. partners in the region, such as Saudi Arabia, Jordan, Egypt, even the UAE, Turkey, and others, can accept. No one wants to be seen as complicit with a second Palestinian Nakba, with the idea of an ethnic cleansing of Gaza. So I think, as you've said, I think the damage has been done. We've already seen many of these countries reacting vociferously, explicitly rejecting this idea. Egypt and Jordan have very good reason to reject it very explicitly. I don't think either country has the capacity to host 2 million Palestinian refugees. They would be met with sweeping domestic opposition if they were seen as being complicit with the ethnic cleansing of Palestinians. And of course, they have security concerns about turning into staging grounds for cross-border attacks by Palestinian armed factions against Israel, because that would obviously put their peace treaty with Israel at risk.
Yeah, I mean, still so many elements of the proposal are unanswered for, including whether the displacement would be temporary or permanent. But this is also just part and parcel of who the president, the U.S. president, actually is. He oftentimes, with any topic, be it tariffs or geopolitical questions, he goes for the most extreme option in the hope that there will be some deal negotiated somewhere in the middle. What do you think he's trying to get out of this stance on Gaza? What are the concessions that he's looking for out of Arab states?
So I think, first of all, we have to be very suspicious about this idea of a temporary displacement of Palestinians. I think it's quite obvious that if we were to see a large-scale displacement of Palestinians out of Gaza, that the Palestinians would very simply not be allowed to return. That seems to me to be the broad trajectory of Israel's policy towards the Gaza Strip over the past year or so. And so I think there is really region-wide skepticism of this idea of a temporary displacement. Now, the question as to what President Trump might be trying to achieve here, there are really, I think, two main possibilities. He's either, as you said, raising the ante, bluffing, using this as a bargaining leverage. There is also the possibility that he's actually quite literal and serious. It's difficult to know at this stage in which direction he exactly is heading. But the issue is that it's really not clear what he wants in return. When it comes to tariffs, the bargaining, the negotiation is clearer. He wants China and other countries to take measures to rectify, rebalance the trade relationship with the United States. There is a clear quid pro quo. In this case, it's not really clear what he wants if he were to be bluffing from the Arab states. He's asking Jordan and Egypt to take in the Palestinians. It's not entirely clear that if they do or if they don't, what this would lead to beyond their taking in the Palestinians. So I don't think, it seems to me that because the implicit ask here is not really clear, I think we would be better advised to take Trump at his word and to take his position at face value. He may, in fact, be trying to engineer a large-scale displacement of Palestinians, an ethnic cleansing of Palestinians out of Gaza, because he thinks that this would be in favor of the long-term security of Israel. So I think that, to my mind, the possibility that he is actually being literal, rather than bargaining for something that isn't entirely clear to me at all, is the greater possibility.
What does this do to the current ceasefire negotiations that are taking place? We're in the middle of phase one. It's been quite tenuous. The discussions have started around the transition towards phase two and perhaps a more permanent ceasefire. But the fact that he's thrown this out there, does that derail the potential progress that we could see?
Absolutely. I think the ceasefire is in really bad shape. I think, in a sense, President Trump, by floating the idea of an annexation and ethnic cleansing of Gaza, really is doing the bidding of Israel's extreme far right. We've already heard Benjamin Netanyahu, during his press conference with President Trump, talk about the ceasefire as being a temporary ceasefire, quote unquote. And so I think he's already paving the way, partly under pressure from his extreme right-wing coalition partners, for a resumption of the war once Israel receives some of its hostages back. And so I think the idea that Benjamin Netanyahu and Donald Trump have also floated about dismantling and disarming Hamas is obviously totally inconsistent with the idea of a ceasefire. Hamas isn't just going to voluntarily, peacefully give up its control over the Gaza Strip. They're not going to disarm themselves. And so for that objective to be accomplished, which Benjamin Netanyahu has placed as one of his top priorities, that would obviously imply a return to the conflict. And so I think if we were to observe these positions, it's quite clear, I think, that the ceasefire is in very bad shape and that we may very well see a return to armed hostilities and to war in Gaza if Hamas doesn't comply, which I think it won't, with Israel's or the US's demands to unilaterally disarm itself.
Yeah. Hasan Alhasan, Senior Fellow for Middle East Policy at the International Institute for Strategic Studies. Thank you so much. And on a programming note, coming up later today, talking about the U.S. economy now, we speak to the U.S. Treasury Secretary, Scott Bessent, live on Bloomberg TV and radio. That's at 10 p.m. across the Emirates, 6 p.m. if you're watching in London. And up next, we're going to be talking about these global markets and hear why Standard Chartered Global CIO Steve Brice says China believes it is more prepared for a trade war with the U.S. this time around. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Asian equities have advanced after stocks and bonds rose on Wall Street in a week marred by tariffs, lackluster tech earnings, and uneven U.S. economic data. Joining us now is Standard Chartered Global CIO Steve Brice. It has been quite an interesting week, not least because of all the tariff noise on Monday, but actually, if you look at macro performance in the last 24 hours, all of those tariff trades are being unwound. So 10-year yields are rallying. We've rallied down to 4.42 on the 10-year. The dollar is losing some steam. So it must be quite a tricky environment to be an investor. But ultimately, do you think that there was too much priced in terms of these tariff trades?
I think with Trump, what you've got to decide is to address it either in one of two ways. So you either have to basically trade the tweets and you become an intraday trader because you don't know what he says today and what he's going to say tomorrow. It could be the opposite. Or you say, OK, we're going to have a bit of a volatile ride. We're going to get a bit of maybe entertainment in terms of the news flow. But don't get knocked off your investment plan. So you sort of look longer term and then take opportunities as they arise through whatever comes out of Donald Trump's mouth. So from our perspective, obviously we favour the latter because we think that's the better way to build long-term wealth. But you really need to decide between those two.
What are you feeling about the dollar here? Again, one of those consensus trades, and it's been on the up for more than a year now, 6 months, I guess. Do you feel like the dollar has peaked?
We're sort of talking about it with clients this week, and sort of even when we're hitting up towards 110, saying it just feels like it's a bit toppish. We know that the dollar's extremely overvalued. And we saw the dollar obviously rally since Trump's election, and people talking about all this tariffs, this US exceptionalism, the tax cuts, deregulation, etc. So that could all lead to a strong US economy, no landing scenario, and that puts upward pressure on the dollar. But, yeah, I think you're right. I think it looks like it's pretty much priced. So our sense is the way I'd probably trade the dollar is saying, look, I'd probably want to short the dollar if we get back towards 110 on the DXY index. You have a stop loss at 110.50 because, you know, if it does break through that, I think that's significant, so you shouldn't ignore it. But we'd probably be sellers on rallies. OK, interesting. Let's talk about yields as well. Scott Bessent, Treasury Secretary, gave an interview to Fox yesterday, but he's speaking to us, to Bloomberg, later today. So perhaps we can get some more commentary around how he's thinking. But one line that did come out of yesterday is he said he wants lower 10-year yields and not Fed cuts, i.e. they don't want to influence the Fed. That's what he's saying. But they would like to see longer-term, lower longer-term yields. Now, the question I have is, how does that square up with an administration that wants to introduce permanent tax cuts to the U.S. economy? Yeah, so obviously, I guess the challenge is one on the inflation and then on the fiscal deficit. So if you look at the inflation picture, obviously we've seen inflation come down, but it's been more stable of late. So from that perspective, the 10-year yield is supported from there as well. And then obviously you talk about the tax cuts in terms of maybe raising the fiscal deficit or at least raising the structural deficit and putting upward pressure on the 10-year yields. But markets didn't react like that. I mean, the 10-year yield has come down quite sharply this week. So I think they're sort of just saying that they're trying to make sure they take the balancing act. I think they will be focused. They realise that the election was lost to a significant extent on the ability of the Republicans to blame the Democrats for inflation. They don't want to be on the other side of that in 6, 12 months' time. It doesn't really matter today. Obviously, Trump has a strong standing within his own party. Doesn't have a strong majority, but he has strong standing. But obviously, as we get towards the end of the year, then we're going to start talking about midterms, and he could be a bit more constrained. So he wants to get done pretty quickly what he wants to get done, and I think tax cuts are high on the agenda.
Yeah, but I mean, again, it boils back to those two dynamics, inflation and the size of the deficit, which is 7% right now in the U.S. Let me just ask you, earnings season, we're in the middle of earnings season. So far, the scorecard has been positive. We are seeing a series of beats, but the reaction for tech earnings has been mixed. Is that going to drive sentiment for U.S. markets?
Well, obviously, tech is a very important component of the U.S. market, right, in terms of its weight. I mean, we have seen more beats than normal, so around 77% of companies have beat expectations. Normally, they do beat, but about 66%. So we're seeing a slightly better than normal beat scenario. So our view is that this is probably going to be a good environment for the stock market. So the US earnings growth this year around 15% is what's expected. Yes, valuations are pretty stretched, so we have to acknowledge that, but they're not super extreme. So our central scenario is that we could see maybe another 10% upside for the US market this year. And obviously, tech is a significant component of that, but we do see it broadening out as well into other sectors. So banks, for instance, we saw significant beats there, and on communication services as well.
Yeah. Steve, great to have you with us. Thank you so much for joining Horizons today. Steve Brice, Global CIO at Standard Chartered. Coming up, China's response to the 10% tariffs. We got the details on the WTO complaint, as well as the latest on the U.S. Postal Service saga. That's a bit later in the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Victorino in Dubai. A lot more green on the boards today. The handover from Asia, a lot more positive than we had in yesterday's session with these Chinese markets fully back in action. S&P futures leaning towards a positive as well, up at 0.2%. NASDAQ up a tenth. Later today, we get Amazon earnings, so watch out for that in terms of the big tech names that have been reporting. And Eurostoxx futures also leaning towards the green as well, up 0.4%. Later in Europe, we'll be watching out for the Bank of England meetings. So that's going to be one to watch later and what guidance they give for interest rate policy. But coming up, it was an earnings beat for ADNOC Gas in its full year results. We'll be speaking to the CFO in a moment. This is Horizons Middle East and Africa. Our top stories this morning. Donald Trump's creative suggestion. The U.S. president's aides seek to tone down his proposal of a Gaza takeover after global condemnation. Beijing takes fresh steps in response to U.S. tariffs, calling for trade talks at the WTO. The U.S. Postal Service, meanwhile, reverses its decision to halt shipments from China and Hong Kong. And Qualcomm and ARM fall in late trading. Slowing smartphone growth concerns hit Qualcomm, while a tepid revenue forecast hurts ARM shares. It's just gone 8:30 across the Emirates. I'm Johanna Victorino in Dubai. A little bit more green on the board today. S&P futures leaning towards a positive, up 0.2%. This after posting its second gain in a row yesterday. So back-to-back gains on Tuesday and Wednesday after that big down day that we had on Monday on tariff day. But of course, with the decision to postpone the imposition of tariffs on Canada and Mexico, we saw a bit of a reprieve for markets. Not so much the case for 10-year yields. We've been rallying, actually. So we've moved down about 10 basis points over the course of the last 24 hours. 4.42 is where we are right now. This as a lot of those tariff trades or the tariff consensus trades in the market get priced out. USD also falling. Not so much today. We're up 6 basis points. But the theme over the last couple of days has been downward pressure on the greenback. The energy complex also in focus today. We've got the Brent crude sitting just below $75, around 74 handle. Yesterday, we dropped 2%. So we actually reached the lows of 2025. This, again, on global growth concerns around the tariffs, but then also a bigger stockpile number coming out of the U.S., higher than expectations. Flipping over, though, today, I just want to point out that we are getting through the earnings season. And of course, the focus is going to be on Amazon earnings later today. But look at the number of beats that have come through. 77% of the names that have reported have actually beaten expectations. And so far, we're about halfway through earnings season. 53% of the S&P 500 have reported. And so far, we are getting higher beats than usual. Our prior guest was saying that typically you get around 55 to 60%. This time around 77% of the names that have reported have beaten expectations. All right, let's also check in on how markets in Asia are faring. Avril is in our Singapore studio. Avril, what have been the main drivers of the price action today?
Yeah, I mean, it's a positive day, and they're tracking the momentum we've been seeing coming back on Wall Street. So that's, I think, the main driver. But when you look domestically, I thought I'd highlight what we're seeing in Japan. You talk about the earnings in the U.S. We're also about more than halfway through the earnings for companies on the Nikkei. We're seeing about 60% that have beat versus estimates. And the biggest beats are coming from a consumer discretionary as well as financial firms. So not too shabby, helping to add to the positive mood. And this performance you're seeing on the Japanese gauges comes despite the climb you're seeing in the Japanese currency. A bit of the dollar-yen move lower this week has been because of the greenback, a slight reversal from the strength. But we also got fresh commentary today from a BOJ board member, the most hawkish among them, saying they see the need for 2 more hikes at least this year, before next year, that is. So providing more impetus for the yen bulls. Among the stocks that we're keeping a close watch on are the automakers, Nissan, Honda. That deal, according to sources telling Bloomberg, reportedly set to collapse. And Nissan is also said to be looking for new partners. The stock enjoying quite a pop today. Jumana.
Yeah, that was a big story that broke on our show yesterday. Nissan, Honda, thank you for bringing us the latest. Avril Hong in Singapore. Now, turning to earnings now, ADNOC Gas has reported $5 billion in net income for the full year, beating the average analyst estimate and 6% higher year on year. Joining us exclusively is Peter van Driel, the CFO of ADNOC Gas. Good morning to you, Peter. Good to have you on. Just taking a look through the numbers that have come through, revenue was also a beat, 24.4 billion versus estimates of 20.8 billion, up 7.5% year on year. And EBITDA, we also spoke about, up 14% year on year. So you must be pretty pleased with these results. What have been the factors contributing?
Yes, it was a very strong result in 2024. The company did, as you pointed out, net income of $5 billion. We serve 2 markets. We supply gas to the UAE, and that gas is used for the power, for the petchem industry, but also we export a lot of our products. Think about LNG, think about LPG. Both in the domestic market and in the international market, the pricing was strong. However, what we see in the UAE in particular is demand is driven by the strength of the economy. You see the population growth coming through. Everybody living in the UAE needs to have access to power, be it your light, your air conditioning. And that demand growth in the UAE has been a key driver for what I call a very strong year for ADNOC Gas.
Yeah, well, you say that those drivers are in place, but let me just ask you, is that going to manifest in terms of higher volumes or in terms of higher pricing, or both in 2025?
It's a combination of both. We've seen both the volumes in the UAE increasing, but also we were able to enhance the margins that we realize, and that is on the back of discussion with our customers, who, for example, want to have more flexibility, and we cater for that And that has an impact on the pricing. In terms of the exports, it's very much a function of what Brent does, and Brent came up 2% compared to 23, which underpinned the pricing improvements in the performance for the export markets.
Yeah. I want to ask you a perhaps bigger picture question. What does the Trump's return to the office mean for the LNG market? And clearly, the U.S. are intent on boosting their own output. Do you expect buyers to move towards the U.S. As a market simply to get favors from the Trump administration?
Today, we produce close to 6 MTPA of LNG, and in 28, we will further grow our production base for LNG with another new facility, Ruwais LNG, and that gives an additional 9.6 MTPA. Both facilities have the majority of their sales subject to long-term contracts. And a long-term contract, you can think when it goes to the Far East, is about 20 years. When it is Asia, Central Asia, it's closer to 10 to 15 years. So in that sense, we're quite resilient in anything that happens around us. And yes, opportunistically, we will send cargoes either to Europe or to the East, and we just see how markets play out. And on the back of that, we are able to optimize our LNG revenues.
Could you give us an update on the Ruwais LNG project and how much of that has been contracted to buyers?
So, in general, ADNOC Gas is all about growth. We will grow our EBITDA by 40% in the next 5 years. And in this year, that growth, we realized already 14%. So we're clearly on track to realize the growth of the 40% EBITDA. Ruwais LNG, which will come and deliver its first cargo on the 2nd of December 2028, is part of. And to date, Ruwais LNG has been awarded its contracts for the construction, and we're on plan. So, as I said, we are ready to sail in December 28, and it gives us an extra boost in the size of the portfolio, but also our reach and ability to serve our customers that we have long-standing relationships with. We will be able to even serve more customers.
Very clear. Peter van Driel, the CFO of ADNOC Gas, thank you so much for joining our show today on a very positive earnings report. Now, the U.S. Postal Service says it's accepting all international inbound mail and packages from China and Hong Kong, reversing an earlier decision to halt some shipments. And News Desk editor Jill Deesas joins us now in Hong Kong. Jill, what is going on here? Why between one day and the next was this decision taken and then rescinded?
Well, ultimately, Jemana, it's a bit difficult to sort of unpack whether this is a political decision or a logistical decision. But I do think one of the things that we can really kind of drill down and explore here is that there are quite a lot of logistical challenges that the U.S. Postal Service, that other shipping companies kind of have to contend with when they're trying to understand some of these latest tariffs from Donald Trump. So what it may boil down to here, and again, there's not an explicit connection here, but what this may boil down to is, as part of the new 10% tariffs that Donald Trump installed on China here, part of that kind of comes down to the revocation of a rule known as de minimis, which means generally when companies are shipping packages abroad, there's an exemption for packages worth under $800 to sort of be shipped into the country duty-free. This is a rule that over the last several years, companies, a lot of fast fashion or e-commerce companies in China, such as Temu or Shein, had really taken advantage of to kind of undercut, other companies such as Amazon. And what we saw as a result here is the number of packages that, sort of were allowed to enter the U.S. under this exemption really ballooned last year, hitting 1.4 billion. So, when you kind of revoke that rule, that kind of throws a lot of logistical questions into disarray here in terms of what a service like the U.S. Postal Service has to kind of account for when they're looking at the packages that are coming into the U.S. There's a lot of concerns over some of these packages coming from China in terms of what kinds of sort of things are contained within these packages, and so you can kind of look at this revocation of this halt on these packages coming in as maybe the U.S. U.S. Postal Service is trying to figure out exactly how to comply with these orders from Trump and where we go from here. I don't think this is the end of this saga. I think we'll have to see, sort of where we go from here. But it does, I think, really throw into consideration here a lot of these logistical challenges.
Yeah, it was a really interesting story yesterday that emerged, and our colleague Rebecca Chung-Wilkins did a report about how it's going to hit Shein and Temu because so many of their price points are sub $800, obviously, when people tend to order them in bulk. But let's just continue the conversation around China and their retaliation to the tariffs introduced by the U.S. The most recent one is they've also filed a complaint at the WTO, which in itself is questionable because the WTO has been lacking in efficacy in the last couple of years. But what are they looking to achieve there?
Yeah, I think that ultimately, what they're trying to do is get a little bit more information about these tariffs. I'm not sure, where we'll kind of go with that WTO complaint, but ultimately just kind of kicks off the start of the saga where, obviously China is trying to challenge some of these tariffs. We have seen, other measures that they've taken, including probes into tech companies like Google. We've reported just recently, actually, that, another part of this may be part of this this complaint about Apple's App Store, not directly tied to the recent tariffs, maybe more of a long-standing concern there, but that's something that, maybe just kind of entering the conversation because of this. I think, at the end of all of this, really, Jumana, is, it does seem like we sort of reignited the U.S.-China trade war here. Sure, there's going to be additional measures, this tit-for-tat measures taken between these two countries against each other, and I'm sure there's just more to come kind of over the course of the Trump administration. One of the things that we're really waiting for right now is whether we actually do get a Xi-Trump phone call at some point to see, whether they can hash out some of these difficulties over the coming days and weeks.
As ever, Jill, thank you so much for the reporting. News Desk editor Jill Desis. Now for a look at some of the other stories we're following today. The U.S. Treasury Secretary says the administration's focus with regard to bringing down borrowing costs is 10-year Treasury yields rather than the Fed's benchmark rate. Asked whether the U.S. president wants lower interest rates, Scott Bessent told Fox Business that Trump is not calling for the Fed to lower rates. Bessent repeated his view that expanding energy supply will help bring down inflation. And Bloomberg has learned U.S. allies expect President Trump's administration will present a long-awaited plan to end Russia's war on Ukraine at the Munich Security Conference in Germany next week. The blueprint is set to be presented to allies by Keith Kellogg, Trump's special representative for Ukraine and Russia. Elements include potentially freezing the conflict and leaving territory occupied by Russian forces in limbo while providing Ukraine with security guarantees. Coming up, Zimbabwe's efforts to woo the UAE gives the African nation a lifeline, even as the country's economy is still struggling. We'll take a closer look next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Zimbabwe's efforts to find favor with the UAE have resulted in the wealthy Gulf states becoming the country's biggest export partner. The UAE has plowed $1.4 billion into various sectors since 2022. But despite that, Zimbabwe's economy remains troubled with a debt pile of $21 billion, high inflation, and a struggling local currency. So to make sense of all of this, as ever, Bloomberg's Andira Ganga joins us with more. Andira, the big question here is what has attracted the UAE to Zimbabwe? Many other players have turned their back on the country.
Hi, Jumana. So the big attraction is Zimbabwe's gold, which has become a bright spot for the local economy. And the genesis of this relationship began in 2019 when Zimbabwe's president went to the UAE for a roadshow to try and attract investment in the country. At that time, this was an economy that was on a free fall, that had been locked out of the capital markets due to sanctions, also default on their debt and years of misrule from the previous administration. And we're beginning to see green shoots in this partnership. You have Dubai Gold and Commodity Exchange saying that they will set up a gold market and then you have a minor bluefin gold group that plans to set up in the country. And there are also plans to develop a 60 billion cyber city that is going to replace the capital city, Harare, that is currently in ruins. If you also look at the UAE, they're part of the country's top 5 foreign direct investment sources. But then again, this is an economy, like you mentioned in the intro, they're struggling with debt, their currency is not stable, inflation is high, legacy infrastructure issues. And emerging market strategies say that investment from the UAE will not be enough just by itself to turn this economy around.
Yeah, but this is a part of the trend out of the UAE to invest more in the African continent. So how does this contribute to the UAE's race to gain and grow influence in Africa?
Jumana, if you look at the investment strategy, they're just taking it one country at a time. If I take you back to last year, they bailed out Egypt's economy for $35 billion. This is equivalent to 7% of the annual economic output. And someone close to the matter told Bloomberg that the UAE was open to doing it again. And we are seeing an influx of Emirati money flowing into the African continent. So far, $110 billion has been invested in sectors like trade, in sectors like renewable energy, food, infrastructure, and also logistics. And this comes at a time when China is scaling back on its loan, EU is scaling back on presence, and US is putting America first under Donald Trump. So a power vacuum is opening up, and whoever has the bigger pass and an open mind to work with African leaders can make play and get to the front.
Yeah, so interesting you bring up the Egypt bailout because, well, I shouldn't say bailout. I should say investment announcement because it did mark the beginning of the turnaround for the Egyptian economy last year. So yes, a notable footprint in Africa. Bloomberg's Ondiro Ganga, thank you so much. Now, AP reports that Rwanda-backed rebels have gained ground in eastern Congo despite the unilateral ceasefire they declared earlier this week. Residents say the M23 group has taken control of a town 100 kilometers from the provincial capital of Bukavu. Forces are reported to be engaged in heavy fighting along the main route to Bukavu. Now, coming along, we'll take a look at chip-linked stocks in Asia following earnings reports from Qualcomm and ARM. More on the all-important, you guessed it, AI outlook next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, ARM Holdings has given a cautious revenue forecast for the current period, adding to recent concern that spending on AI computing is slowing. Meanwhile, Qualcomm, the world's biggest seller of smartphone processors, fell in late trading on investor fears that demand for new handsets will stall in 2025. Let's bring in Bloomberg tech reporter Annabelle Jewelers for more. Maybe let's just start with Qualcomm. What is the read across to the smartphone industry, given that they manufacture the processors that go into these smartphones?
Well, there's a really strong read across, and it's been an interesting earnings release because we actually saw some pretty mixed moves in late trade. Initially, the stock rose, and that was because there was really a lot of positives in these numbers. It was a broad outperformance across a range of different business segments. We saw earnings per share, for instance, up around 24%. Revenue for the quarter as well, that reached $11.67 billion. The second quarter revenue forecast as well, that was strong, between $10.3 billion to $11.2 billion. The estimate had been for 10.35, but the concern and why we actually saw the stock and after hours flip into negative territory and close down 5% was because there was this concern around the tech licensing business, and that really came into focus. So tech licensing, this is actually a really small part of the overall pie, but they forecast sales of around $1.25 to $1.45 billion. The estimate had been for $1.4 billion. That's based on an estimate of smartphone sales from IDC. And so if they say weaker sales for that segment moving forward, it tells you perhaps they also see a weaker or a slowing smartphone market as well.
Yeah, let's talk about ARM as well. I'm just curious to see the price action and why the investor community took it so negatively, because ultimately it looks as though a lot of the results actually beat or came in line with expectations. So are we seeing some form of a DeepSeek impact here?
it's certainly, it still relates back to DeepSeek in particular, and this sort of question that a lot of people have: are we going to see more of that trend toward small language models instead of large language models like ChatGPT? And if you see that, are the same sort of resources needed? And so, I mean, this report as well, it came off the back ARM, it came off the back of AMD, and it was really relating to that weaker or softer outlook moving forward. And so they're expecting revenue of between $1.18 to $1.28 billion in the fiscal fourth quarter that runs through the end of March. That actually was an increase from the prior forecast, and again, it was largely meeting a lot of different estimates on Wall Street, but it didn't meet the loftiest, and that was around $1.33 billion. So it's sort of just that general recalibration we seem to be seeing right now, which is so much exuberance around AI. It seems to be running into a little bit of trouble, and really what is behind some of that as well is this launch of DeepSeek.
Yeah, and the majority owner of ARM is SoftBank, but SoftBank are also in acquisition talks to acquire Ampere. What do we know about that, and how will it complement their portfolio?
Yeah, well, this is actually another chip designer, and it's been something that's been underway for quite a period now. So actually, Bloomberg News was reporting last month, for instance, that they were in talks for this deal. So it's going to be valued perhaps at around $6.5 billion, including debt. We're hearing that transaction could be announced over the next couple of weeks, rather. It's interesting as well, that valuation, which has been mooted of $6.5 billion, because actually, going back to 2021, Bloomberg was reporting at that point that SoftBank was interested in taking a minority stake in the chip designer, but it was at a valuation of $8 billion. So there is certainly a lot of different companies that are interested in essentially capitalizing on the spending boom in AI. But given you've got that lower valuation now being suggested, it does also tell you that there's increased competition in the space.
Yeah, most definitely. That's one of the signals that is coming through from this earnings season. Bloomberg's Annabelle Jewelers, thank you so much. Well, a quick look at equities before we head out into the second hour of the show. Leaning towards the green, better end for Wall Street yesterday. This is all your futures. Your stocks futures leading the charge, up 0.4%. But coming up in the next hour, we discuss the U.S.-China trade war with Eugenia Victorino. I'm Johanna Brice in Dubai. Stay with us as Jennifer Zabazaja joins me from Johannesburg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Donald Trump's creative suggestion. The U.S. president's aides seek to tone down his proposal of a Gaza takeover after global condemnation. Beijing takes fresh steps in response to U.S. tariffs, calling for trade talks at the WTO. The U.S. Postal Service, meanwhile, reverses its decision to halt shipments from China and Hong Kong. And Qualcomm and ARM fall in late trading. Slowing smartphone growth hits Qualcomm, while a tepid revenue forecast hurts ARM shares. Good morning again, everybody. It's just gone 9 a.m. across the Emirates. I'm Johanna Brice in Dubai.
And I'm Jennifer Zabazaja in Johannesburg, where it's just gone past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. And Jumana, we're seeing a bit of calm, a different day to start as opposed to what we were seeing just a few days ago.
Yeah, and certainly that's being reflected in markets, Jennifer. The handover from Asian stocks today is slightly more green. And you can see the futures board behind me as well, tilted towards the green as well. This after better close for Wall Street. So the second day in the row that S&P posts gains, and this after that deep decline that we got on Monday after the tariff scare. But of course, since then, a lot of those tariff trades in the markets has started to be priced out. So take a look at the 10-year Treasury yield, for example, 4.42, rallying a full 8-9 basis points yesterday. We did get a slightly disappointing ISM services print, but beyond that, it feels as though many of the trades that the investment community had put on to play for the tariff impact and potentially the inflationary impact of tariffs are now being unwound. So 10-year yields are lower. The dollar today slightly higher, but the theme there has been one of weakness. And in fact, the DXY index is sitting at its lowest level in the past week, despite the gains over the last 6 months. Energy in focus as well. Brent sitting below $75, but yesterday we came off 2% in trading. Again, on growth concerns around the tariff, what that means for the rest of the world, global demand, but then also a higher stockpile number coming through from the US as well, putting some downward pressure. Flipping over, today's a big day in the UK. It's the Bank of England rate decision. The markets are pricing in a 90% chance of a 25 basis point rate cut. But as ever, the Bank of England are battling with the dual focus of one, a weakening growth backdrop in the background. So we've got UK GDP basically stagnating, not really growing. It's flatlining here around 0%. But at the same time, the inflation numbers continue to be quite hot in the UK, though we did start to see some moderation come through in the latest print. So this is the balancing act that the Bank of England has ahead of them today. Let's move on and check on how markets in Asia are faring as well, though. Avril Hong is in our Singapore studio. A lot more green on the board today.
Yeah, including in China, where we're back from the lunch break. So let's just check in on how equities there are faring. That positive mood from the morning session continues. A lot of this coming from the AI robotics related story. You can see how the tech-heavy Chinex is faring today, but also a bit of a mood lifter coming from holiday spending data showing Chinese consumers splurged over the period. And you're looking at records in terms of travel, movie attendance. So it's helping to lift the mood a little, but some of our resident skeptics on the MLive blog have also been highlighting that it's kind of hard to ensure a broad-based rally if you think about how the tariff risks continue to weigh. And we also got really weak services data just earlier this week. So against that backdrop, we're seeing the stocks bounce today, but question marks as to how long this lasts. In the meantime, we're seeing the Chinese yuan dollar China hovering towards the 7.29 level, continued weakening and catch down on the onshore renminbi to what we're seeing on the offshore renminbi. Guys.
Avril, thank you so much. And also shout out to our resident skeptics, the in-house skeptics from MLive. You're right. All right, moving over to regional politics now. Aides to President Donald Trump are playing down his proposal to, quote, own Gaza. That's after the U.S. president suggested his country should take over and redevelop the coastal Palestinian territory while displacing its residents to neighboring Egypt and Jordan. White House Press Secretary Caroline Leavitt calls it an out-of-the-box idea.
The president has not committed to putting boots on the ground in Gaza.
Is the U.S. prepared to remove Palestinians from Gaza by force?
The president is prepared to rebuild Gaza for Palestinians and all people in the region.
Why not rule out the idea of committing U.S. troops? This has been a long-standing argument that the president has made really over the last decade or so, talking about endless wars and not something the U.S. wants. Why not rule out troops?
Because I think the president is very good when he's making deals and negotiating, not to rule out anything, because he wants to preserve that leverage in negotiations.
Should be said that the announcement was criticized by, amongst others, Saudi Arabia, Egypt and France, but welcomed by many lawmakers in Israel. So let's go to Jerusalem now and speak to Bloomberg's Dan Williams. It certainly was a Trump earthquake yesterday, those comments around Gaza. And we spoke about the likelihood and the viability of this plan actually being implemented. Let me just ask you about the reception it has had within Israel to start.
Well, as you noted, this has been welcomed right from the top. Prime Minister Netanyahu positively beamed in Washington at the White House at the side of Trump, although there are some indications that the Prime Minister himself may not have been fully informed about the extent and the level of detail that Trump would commit to this proposal. He seems to have adjusted very quickly to it and welcomed it. Of course, other members of Israel's right-wing camp have really exulted over it. The reception has been more moderate, welcoming perhaps, but with some caution the more you go toward the centers of the political stage in Israel, given, I think, realization that the logistics of what Trump proposes and the politics would be quite difficult, regionally speaking. As you noted, the aides to the president have been, if you called it an earthquake, perhaps they've been trying to recast it as more of a tremor. a way of opening up the Overton window of discussion of this very touchy issue dating back decades, and enabling fresh thinking among all parties involved in these negotiations.
Yep, I do want to bring it back to the here and now. The reconstruction plan was always going to be part 3, phase 3 of this ceasefire agreement that's in place right now. We know that the ceasefire is still quite tenuous. Discussions were supposed to be taking place this week about moving from phase 1 to phase 2. Does the fact that President Trump has made this shock announcement derail the progress on the ceasefire discussions?
Quite the opposite. I think it's worth noting that the president himself said at the same event that those negotiations would be now addressing phase 2. As far as he's concerned, the ceasefire talks are still in force and indeed continuing. And there's some indication that his comments, his very ambitious, unprecedentedly ambitious plans for the Gaza Strip may have been aimed to actually calm the Israeli far right and keep them on side while Israel continues in discussions with Hamas on a ceasefire that may eventually leave Hamas in power in some form in the Gaza Strip, although Israel has denied that this is something it would accept. Basically, if they are happy with a long-term plan proposed by Trump for the Gaza Strip, the far right in Israel may object less to continuing to talk with Hamas, as if Hamas will be a long-term partner, or at least a long-term address in the Gaza Strip. Hamas will not be removed or destroyed anytime soon, because it's rather hard to see how Israel can continue negotiating with Hamas on a release of hostages while Hamas is actually wondering about its own future survival. If Israel is openly promising with US support to eventually dismantle, destroy, exile members of Hamas. So if the far right in Israel is happy for now with a US master plan, it may be okay with the more immediate concerns of these ceasefire talks, which entail keeping Hamas in place to deliver those hostages and continue the negotiations.
Yeah, and therein lies the perhaps a contradictory situation that these negotiators find themselves in. Bloomberg's Dan Williams in Jerusalem. Thank you so much for the report.
Thank you.
Let's turn to the trade war now. The U.S. Postal Service says it's accepting all international inbound mail and packages from China and Hong Kong, reversing an earlier decision to halt some shipments. News Desk editor Jill Desis joins us now in Hong Kong for more. So, Jill, can you explain the latest twists in this saga? There's been a lot of back and forth over the past 48 hours about this.
Yes, that's right, Jen. So, look, the U.S. Postal Service hasn't, kind of come out and explicitly tied this to some of the, concerns over the trade rules that we've really seen here. But, so it's difficult to tell whether this is really a political decision or a logistical decision to reverse this decision. But what it really is kind of bringing to light here are a lot of the logistical challenges behind enforcing some of Donald Trump's tariffs on China. Ultimately, as part of this 10% tariff, it seemed that Donald Trump also wanted to revoke what's called the de minimis rule, applying to, sort of exempting smaller packages worth less than $800 per package from duties when they're, transporting that to the United States. A lot of e-commerce companies in China actually were taking quite a bit of advantage of this exemption over the last couple of years. Think of companies like Shein, the fast fashion retailer, or Temu, also another e-commerce company shipping, low-cost goods to the United States. So, by revoking that rule as part of this escalation in the U.S.-China trade war, assume that the U.S. Postal Service would actually have to check all of these packages, what amounts to, some $1.4 billion last year for, whether or not they were in violation of certain U.S. rules. That's potentially what played a part here in, sort of this decision to first halt packages, but then obviously, kind of reverse that decision as they're kind of, wading through the logistics of this. I think, Jen, what you can really kind of take away from this entire back and forth is that there's a lot of, concerns here about how to ultimately implement some of these tariff rules that Donald Trump wants to put in effect. And there's a lot of concerns over what that actually does to supply chains and kind of, shipping considerations here. I don't think that this is the end of this saga whatsoever. We'll have to kind of see how that continues to develop in the coming days.
And Jill, I mean, there appears to be more pressure, many people wanting there to actually be some discussions being had, at least from the Chinese side. We've seen now there's a WTO complaint in the works there. I mean, how is China responding now?
Yeah, so Jen, it looks like what China has ultimately done. I mean, they're clearly blasting a lot of the tariff restrictions that the U.S. is putting in place is unfair. Bringing that to the World Trade Organization to attempt a resolution that does seem to be stage one here. Obviously that's in addition to some of the retaliatory moves that we really saw China take. That included things such as a probe into Google, for example. There's some additional tariffs that that China put in place on energy from the United States in response as well. So that kind of plays into this. I think the really big thing to look out for going forward is whether or not there's actually going to be a call between Presidents Donald Trump and Xi Jinping. That's something that Donald Trump initially earlier this week said he thought was going to take place within a day or so when we were first waiting to see these tariffs actually take effect against China. Then later he said, well, we don't need to necessarily rush into that or do that immediately. So I think it just kind of, shows that there's at least some desire to kind of open up an avenue of communication here. We have seen the trade war, at least this time around during Donald Trump's tenure, get off to maybe a bit of a slower start than we, or at least, sort of a lesser start than we did the first time around. I mean, the tariffs that we're seeing put in place, some of the response measures from China haven't been as aggressive. We'll have to see whether or not that call takes place and where we go from here.
Right. A bit more subdued is really what we're seeing. Jill Desis, our news desk editor there in Hong Kong with the latest. Jill, thanks as always for joining us. Now, here's a look at some of the other stories we're following this morning. The U.S. Treasury Secretary says the administration's focus with regard to bringing down borrowing costs is 10-year Treasury yields rather than the Fed's benchmark rate. Asked whether the U.S. president wants lower interest rates, Scott Bessent told Fox Business that Trump is not calling for the Fed to lower rates. Bessent repeated his view that expanding energy supply will help bring down inflation. Bloomberg has learned U.S. allies expect President Trump's administration will present a long-awaited plan to end Russia's war on Ukraine at the Munich Security Conference in Germany next week. The blueprint is set to be presented to allies by Keith Kellogg, Trump's special representative for Ukraine and Russia. Elements include potentially freezing the conflict and leaving territory occupied by Russian forces in limbo while providing Ukraine with security guarantees. Now, coming up, SEB's head of Asia strategy says Beijing's measured response to the U.S. tariff signals a reluctance to escalate into a full-blown trade war. We'll speak with her next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Johanna Victorino in Dubai. Asian equities have advanced after stocks and bonds rose on Wall Street in a week marred by tariffs, lackluster tech earnings, and uneven U.S. economic data. Joining us now is Eugenia Victorino, head of Asia strategy at SEB. Thanks for joining us, Eugenia. Maybe let's just start with the response to the U.S. tariffs out of China. And we got that earlier this week. And some people were saying that it actually was a little bit more measured than what they did the first time around, that the U.S. and China entered into a trade war. There wasn't a tit-for-tat tariff race going on, so to speak. China chose a more targeted approach. What do you read of the response?
Indeed. So I think both presidents are actually just now playing to their own audiences. So like in China, in the case of China, it was a clearly measured and cautious response to the fresh tariffs. But some of the response is actually very symbolic. So this, in my view, is really showing the reluctance of President Xi to intensify the current trade tensions. That is not to say that it will not intensify, at least in the coming 4 years. 4 years is a long time, so it can always get worse from here. But at this point, I think the market is taking some breath of it's taking some breath of comfort from the fact that it's not getting worse from here.
Yeah. Do you think the Chinese economy is better equipped this time around to deal with U.S. tariffs?
Well, indeed. I mean, at least at at the first instance, the expectation or the exposure to the U.S. market as far as the export basket is concerned is already quite substantially low. In 2018 and 2019, around 20% of China's exports would go to the U.S. These days, it's only around 15%. So as far as Chinese exporters are concerned, the U.S. is not the only game in town anymore. So they've really stepped up on their efforts to expand their presence in the other, even smaller markets across the world.
Eugenia, when it comes to Chinese equities, then, is this enough for you to confidently say we will see a sustainable, a broad-based rally in equities?
It's a bit difficult to say that we would see a sustainable rally. The fact that the market reaction to the fresh tariffs is a little bit more orderly doesn't mean that there is room to really rally from here. Unless we see a good or a substantial improvement in consumption in the Chinese market, it's difficult. Having said that, we have seen the impact of the DeepSeek and the positive impact on the sentiment for the Chinese equities. But then that's not going to be the entire index. It has to be a stock-picking approach, which is not really reflective of a strong economy.
Eugenia, in terms of safe haven demand, we've really seen the beneficiaries at this point when we look at assets being gold at this point. Do you see this extending outwards to other assets throughout the markets?
Well, at this point, I think it's very clear that the Japanese yen has picked up its safe haven characteristic since the Trump administration has been in power. So we've already seen the dollar yen go down to slightly above 152. So against this backdrop, we are seeing safe haven demand for Japanese yen, but at the same time, we're also seeing that the BOJ is actually opening the possibility to raise the policy rate even up to 1% by March next year. So in that scenario, whether it's the BOJ hiking or the safe haven, I think the yen is a winner from here.
Yeah, it certainly appears to from the price action over the last couple of days. Let me just ask you a question vis-a-vis the Fed. Markets' expectations of what the Fed is going to do have been massively dialed back, and there's a feeling that they will maybe cut once or twice this year and keep rates in restrictive territory. What does that mean for some of the Asian central banks that you follow? Are they likely to follow suit as well?
Well, at this point, I think the market has already faded the maximum hawkishness that they were pricing in at the beginning of the year, and now the market is already pricing in as much as 2 cuts. Now, that doesn't necessarily mean that the Fed will stop at 2 cuts, because the Fed did say that even though they are cautious in their approach, they are willing to dial up on the easing should the economy falter from here. So it's not as if it's really going to stop at 2 cuts from here. Having said that, we've already seen that the 10-year yield has gone down from around 4.8 to less than 4.3%, and that is already showing some comfort, providing comfort to the other central banks in the region. But if the Fed is stuck at 2 cuts for the year, it's a bit difficult to go aggressive on the easing for the Asian central banks.
And what about yields? We just have them up here sitting at 4.43% further out the curve. What does that do to bonds and duration opportunities in the region as well? Is it going to keep everything elevated?
So actually, as I said, the U.S. yields have actually pulled back from the peak in January. And this is also reflecting the fact that U.S. data, while it is still resilient, it is actually coming in a little bit weaker than expected. And indeed, if you look at the surprise index in the U.S., it's actually losing momentum. So if you put it all together, then it is very understandable that the U.S. yields will go down from here. And that would also provide relief for the bond market in Asia.
Eugenia Victorino, head of Asia strategy at SEB. Great to get you on, as always, and to get your insights. Thanks so much, Eugenia. Now, coming up, sticking with central banks, the Bank of England is widely expected to cut rates today. We dig into the economic backdrop driving that view later, live from London. Stick with us. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Johanna Victorino in Dubai. Now for a look at some of the other stories we're following today. French Prime Minister François Bayrou has survived 2 no-confidence motions in Parliament, assuring the passage of his budget following months of political turmoil. France is on its 3rd government since President Emmanuel Macron called snap elections last year that fractured the National Assembly. French bonds rallied this week, although Bayrou describes the budget bill as imperfect. And speaking of France, just getting some breaking news coming through. SocGen earnings are out, and we've got a beat. 4th quarter net income has come in at 1.04 billion. That is through the estimates of 860.8 million. To give you more commentary as well, the net banking income came through at 6.62 billion. The estimates were 6.41 billion. So that is a beat as well. The guidance for this year, they see net banking income above 3%, and they see 2025 return on tangible equity above 8% as well. Cost income ratio at 66%. Estimates were 66.4%. So we got a beat coming through from SocGen. You can see over the course of the last year, up 37%. But coming up, we are going to be turning our attention to Saudi Aramco and what's been happening with prices.
This is Horizons Middle East and Africa. Our top stories this morning. Donald Trump's creative suggestion. The U.S. president's aides seek to tone down his proposal of a Gaza takeover after global condemnation. Beijing takes fresh steps in response to U.S. tariffs, calling for trade talks at the WTO. The U.S. Postal Service, meanwhile, reverses its decision to halt shipments from China and Hong Kong. And Qualcomm and ARM fall in late trading. Slowing smartphone growth concerns hit Qualcomm, while a tepid revenue forecast hurts ARM shares. It's just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Johanna Victorino in Dubai, where it's just gone 9:30 a.m. Welcome to Horizons Middle East and Africa. As we were speaking about earlier, Jen, markets slightly calmer overnight, better handover from Asian equities, Wall Street ending up in the green. But then also some comments coming through from the Treasury Secretary Scott Bessent, and that is going to be key for investors, like hearing what the Treasury Secretary has to say. And he repeated yesterday that what they want to see is lower yields, but not necessarily lower interest rates out of the Feds. Interesting.
Yeah, exactly. Yeah, exactly, Jumana. And I think we're going to continue to see the markets parse through those statements as the session gets going later today. But let's just take a look at where the markets are right now. You were just mentioning there some of those comments from Scott Bessent. What we did see on Thursday, or what we're seeing on Thursday, is calm, as you were mentioning there. We are seeing Treasury yields rising ever so slightly, but still, Wednesday was quite a choppy session, and that's coming just off the back of a lot of those gyrations that we heard earlier in the week in regards to Trump's tariff threats. But right now, the 10-year Treasury yield is holding near lows of the year right now at 4.43%. And of course, we are going to continue to see how the markets react to those comments from Bessent about bringing down the 10-year Treasury yields rather than the Fed's benchmark short-term interest rate. S&P futures up as well, marginally, just about 0.2%. We did see Wednesday the S&P notching a second straight day of gains. We're still in the middle of earnings season. Hard to believe that. More than 50% of S&P companies have reported earnings, and we have seen more than 77% of them actually beating estimates. The dollar also in focus as we take a look at what's happening with yields. Largely unchanged right now, but still with a focus on that, as well as Brent crude trading just about at $74.74 a barrel there. And we did see crude dropping over 2% to a 2025 low, weighed down again by those rising U.S. inventories and, again, uncertainty around tariffs and really what happens next. And we were speaking to Eugenia earlier about some of the safe havens in the market, which brings me to one of the safe havens that are really continuing to show more and more strength, and that is gold, as this chart is showing. Gold prices rallying to a new all-time high, exceeding $2,882 an ounce before pairing some gains. But as Eugenia was saying earlier, it's not just gold. We're also seeing some haven demand going into the yen. But let's turn now to markets in Asia. Avril Hong is standing by in our Singapore studio with a bit more on that. Avril, what are you watching?
Yeah, Jen, you've been talking about how we're in the midst of earnings reporting. I thought I'd just highlight one of the companies that are set for reporting tomorrow in the Asia Pacific. That's Chinese tech giant Alibaba. And it's really interesting, the price action we've been seeing in the stock in the past 1.5 months. This is a climb that's quite pronounced compared to what we're seeing among the Mag 7's performance. And this chart, courtesy of MLive's Mark Cranfield, shows you how it's sort of closing the gap and perhaps demonstrating the investor view that this is a firm that will continue to benefit from the DeepSeek AI narrative. That being said, of course, we'll have to watch for what exactly the outlook it shows for the months ahead. There are also trade tensions and then some of these policy flip-flops, including from the US Postal Service, that have not been helpful for some of these Chinese e-commerce names. But that being said, given how the stock's been gaining traction, it might draw investors to kind of take a closer look at the company's metrics. So that's among the things that we're keeping an eye on in the Asia Pacific.
Thanks so much, Avril Hong in Singapore for us. Really appreciate that. Now let's turn it back to the Middle East. And Donald Trump saying he's willing to work on a new nuclear deal with Iran to allow the country to, quote, peacefully grow and prosper. The U.S. president did not give details on the plan, but posted on social media that reports of the U.S. working with Israel to, quote, blow Iran to smithereens are greatly exaggerated. The U.S. has long accused Tehran of using a decades-old civilian nuclear program to disguise ambitions to develop weapons. Iran denies those claims. Joining us now to dig into this is Onar Ant, Bloomberg's managing editor for the Middle East and North Africa. Onar, always great to have you on the show. So what does Trump want to do here with Iran? This is very different than what we saw from Trump 1.0 just a few years ago.
That's correct. There is a difference in the way he approaches it. But I think the U.S. Tactic or strategy to exert so-called maximum pressure on Iran has been revolving around one key premise, and that is to offer Iran economic relief in return for curbs on its nuclear activities. That, I think, remains unchanged in this particular point. And what is important to note, I think, at this point in history is that there is also another competing priority for President Trump, and that is to be able to create a market situation, global market situation, whereby he can deliver on his own domestic election pledge to lower oil prices globally. So what we are seeing is that President Trump is basically laying out the options for Iran. On the one hand, he showed with his directives the other day that he has the ability to A, impose new sanctions on Iran, and B, he can impose or he can reinforce existing sanctions on Iran than what was the case under Biden. And on the other hand, he is offering a carrot, which is basically a situation whereby Iran can live with maybe more relaxed sanctions, can generate more revenues from its oil exports in return for curbs on its nuclear activity, because that's been at the heart of global powers' concerns vis-a-vis the government in Tehran.
Onar, does that mean we see Iran then playing ball? Is that enough incentive for them to step in and come to the table?
It might be. Based on various calculations, based on various assumptions, there is a possibility that the U.S., with new sanctions or the reinforcement of existing ones, can so to speak, below a $30 billion hole in annual revenues that Iran generates from oil exports, mainly to China. They have been able to almost quadruple their oil exports under the Biden administration. There is a way that Trump can reverse that, and that would be a big concern for Iran. That is due to the fact that A, oil accounts for almost a tenth of the Iranian economy, and B, the country is already suffering from lack of investment that are showing themselves in terms of massive blackouts, hitting companies in key industries. So it is critical for Iran, as has been signaled by its new president, Pezeshkian, to come to terms with the West, the global powers, to reach an equilibrium where it can basically generate more revenues from its oil revenues and provide more prosperity for its own population.
Right. We'll see where this develops next. Onar Ant, Bloomberg's managing editor for Middle East and North Africa, there with the update. Onar, thanks so much.
All right. Well, let's talk about Aramco now. Saudi seems to have raised the oil prices for its Asia shipments. Bloomberg's Anthony DePaula joins me to talk more about this. It's interesting because when I sat down with the CEO, Amin Nasser in Davos, one of the questions that we spoke about was whether demand from Asia was picking up because of these new sanctions that had been then imposed by the Biden administration on Russian producers, Russian exporters. And he seemed to imply that, yes, that was the case. But of course, now we're seeing that the price of those shipments has actually gone up. So why do you think they have this pricing power now?
Yeah, it's a confluence of factors going into the Asian market. China has been really sluggish to come back in terms of boosting growth since COVID. It's been one of those stories that we're waiting for China to come back, waiting. And Aramco, particularly Amin Nasser, has always been very bullish on China demand, but it hasn't really come through for them as they wanted in the last couple of years. Now, what we're seeing with the OPEC Plus cuts is that they are keeping oil off the market. It's that kind of heavy sour oil that the Chinese refiners like to use a lot of. So it's keeping that oil off the market. It's constraining those supplies. So we have seen some increases in the prices for the Middle East crude. That's been compounded by the fact that you mentioned of those sanctions, which is a sanction on some of the Russian shipping, making it difficult for some of those Chinese refineries and some of those ports to offload those Russian crude cargoes. So that sparked earlier at the start of this year a real flurry of activity looking for alternative barrels, and that's really pushed up the relative value of the Middle East barrels in the market.
Interesting. So there's a scarcity value being assigned to the crude put out by Aramco. Slightly different tack, but also very important for the oil markets here. There's been a lot of noise coming through from the U.S. administration in the last 24 hours, but buried in the news yesterday, he did actually introduce a new directive that would allow for stronger enforcements of Iranian sanctions. What impact is that likely to have in reality on Iranian oil exports, if at all? Because now, today, he's talking about the possibility of a deal.
Yeah, so right there you're saying it could have a lot of impact or could have none.
Right.
If there's a deal, they will presumably sanctions would have to be part of a deal, part of the quid pro quo. So there would have to be some of those sanctions potentially coming off or some waivers issued like we've seen in the past. If there is that resort to maximum pressure, then what we've seen in the past is that Iranian exports were cut almost to zero. We've seen levels 3, 4, 500,000 barrels a day, which is roughly a million barrels less than where we are now. Those same sanctions are on the books. What that executive order that Trump issued, I think was Monday night, Tuesday night, depending on the time, was that it just referred to strengthening and enforcing those sanctions that are already on the books, potentially looking a little bit more closely at some of the payment mechanisms. So really it's talking about, implementing those same sanctions that we currently have on the books now. But at the same time, he says, well, I don't want to do that. I'd rather have a deal. So that really opens things up. And we see oil coming off on that. So we've still got that kind of residual stickiness of those Russian sanctions, but we're not seeing that kind of knee-jerk reaction in terms of prices on the Iranian sanctions, meaning people don't really think that's going to be too much of an obstacle to supply.
Yeah, as one commentator earlier on our show said, you shoot first and talk later. That's the Trump strategy for, it seems to be, everything these days. Bloomberg's Anthony DePaula, thank you so much. Now, coming up, the Bank of England is expected to cut rates again when policymakers meet today. We'll preview the central bank's path forward as it navigates above target inflation next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. Well, to the UK now, and the Bank of England is expected to cut rates at its meeting today. Policymakers, however, are warning that further easing will be gradual. We're also looking out for updated growth and inflation forecasts. Joining us now with a preview is UK correspondent Lizzie. So let's just talk about what is priced in for today. 90% of a 25 basis points rate cut is actually priced into the market. But it seems as though investors are going to be looking ahead to commentary about the future interest rate path. What can we get out of today? What do you think we're going to get?
You're absolutely right, Joanna. And the reason that it is so almost fully priced is because of the economic landscape, of course, here in the UK. We're between the US and the euro area, not just geographically, but also economically, given that you've got weak growth, but also this pickup in inflation. The expectation is that you get a vote split of 8-1, so the same as the November meeting, but it would be a dovish surprise for markets if you saw Catherine Mann voting to cut rates as well, or if you saw the Archdove on the committee, Swati Dingrat, voting for a jumbo cut. And as you say, the other thing that markets are watching out for is the path ahead. The expectation being that they do not ditch the line in the guidance, that a gradual approach to removing monetary policy restraint remains appropriate.
Yeah, this also is a meeting where we get their latest forecasts, their projections. The backdrop to all of this, as you say, is still quite high levels of inflation, although they've started to come down, and an economy that's essentially stagnating, growing around 0%. So how much of that do you think is going to be, interpreted, how is it going to be interpreted by the market, but then also how will it be interpreted by the government? You've got to think the Chancellor is watching these numbers very closely as well.
She will indeed, and the spectre of stagflation hangs over this decision because the expectation is that they're going to downgrade the growth forecast and raise the inflation forecast. I would say that this is based on an outdated market curve, so it's a delicate job for the Governor Andrew Bailey to communicate. He'll either have to push back on market pricing or else appear to be criticising the Chancellor's budget. But it'll be embarrassing nonetheless for the Chancellor, given, number one, of course, her top priority is economic growth, and two, it may be that the payroll tax rise in her October budget has added to expectations for inflation more than initially thought. Now, aside from that, as you say, Rachel Reeves really going to be watching this closely because it will give an indication of her headroom. Officially, it's the Office for Budget Responsibility that will decide that, but it will give her a clue as to whether she'll face a choice down the line between raising taxes again, cutting spending, or breaking her fiscal rules, which she says are non-negotiable.
Yeah, well, there's going to be a lot hinging on this interest rate decision, not for today, but for the path ahead. Love a good Bank of England day. Lizzie, looking forward to your reporting on Threadneedle Street later today. Well, on a programming note, coming up later today as well, we will be speaking to the U.S. Treasury Secretary Scott Bessent live on Bloomberg TV and radio. That is at 10 p.m. across the Emirates and 6 p.m. if you're watching in London. And coming up, Zimbabwe's efforts to woo the UAE is giving the African nation a financial lifeline. So why is the country's economy still struggling? We'll have that story next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Zimbabwe's efforts to woo the UAE have resulted in the wealthy Gulf state becoming the country's biggest export partner. $1.4 billion has been invested in various sectors since 2022. But despite the investments, Zimbabwe's economy remains troubled. The African nation has a debt pile of $21 billion, high inflation, and a struggling local currency. Bloomberg's Andira Oganga is on the story and joining us us now and is joining us now. So, Ndiro, talk about why the UAE is attracted to Zimbabwe, especially when we look at a lot of other countries that have essentially shunned the country going forward.
Hi, Jen. So what attracted the UAE to Zimbabwe is their gold, which has become a bright spot in their local economy. And the genesis of this relationship is in 2019, Zimbabwe's president went to the UAE for a roadshow to try and attract investment into their country. It was a time when the economy was literally on a free fall. They'd been locked out of the capital markets due to sanctions. They defaulted on their debt and also years of misrule from their previous administration. And we're beginning to see this partnership bear green shoots. Dubai Gold and Commodity Exchange have made a pact with Zimbabwe to establish a gold market. Then you have Bluefin Gold Group, which is a miner that is planning to set up in the country, and also a $60 billion cyber smart city that is being set up to replace the current capital city, Harare, that is in ruins. If you also look at UAE, they're part of top 5 foreign direct investment sources for Zimbabwe. So the relationship is bearing fruit that Zimbabwe would have liked to see. But experts are also saying that this is not going to be enough. This is an economy that is crashing under the weight of debt, legacy infrastructure issues, unstable currency, and they need more than inflows from the UAE to stabilize their economy.
Well, when we talk about this partnership, does this do more for the UAE potentially in gaining influence across the African continent, especially when you look at some of the other Gulf players that are trying to do the same?
It does, and they're doing it one country at a time. If I take you back to last year, Egypt, where they were able to invest a total of $35 billion at a time when nobody was willing to give Egypt money or bail them out of the economic crisis that they were going through at the time. And this amount is almost 7% of the total annual economic output from EU. And someone close to the matter told Bloomberg that they're willing to invest more of this amount if the opportunity presents itself. We are seeing an influx of Emirati money onto the African continent. $110 billion have been invested so far in areas of trade, infrastructure, food, logistics. And this comes at a time when China is scaling back on its financing on the African continent. EU is scaling back its presence. And you have US that is putting America first under Donald Trump. But it's also important to say, while diplomatic relations are very important in trying to build influence, there's massive prospects of profit because UAE is daring invest in countries that many are not trying to touch.
Absolutely, and in so many sectors. Bloomberg's Ndiro Oganga joining us with the latest there. Ndiro, thanks as always for your reporting. Now, for a look at some of the other stories we're following this morning in the region. Kenya's central bank has cut its benchmark interest rate to an almost 2-year low. The MPC lowered the key rate from 11.25 to 10.75%. This as benign inflation in Kenya gives the central bank space to prop up the stuttering economy. And sticking with Kenya, the IMF says it's in talks with the government for a program to follow on from an arrangement that expires in less than 2 months. Kenya is reported to be looking for a funded program with its existing $3.6 billion 4-year deal scheduled to run through to the start of April. And Candy Crush is one of the games driving a boom in Africa's gaming industry. According to ADG Technology, the continent's industry grew almost 6 times faster than the global average last year, spurred by demand for entertainment on mobile phones. The market expanded by 12% to reach revenues of $1.8 billion last year. And finally, the AP is reporting that Rwanda-backed rebels have gained ground in eastern Congo despite the unilateral ceasefire they declared earlier this week. Residents say the M23 group has taken control of a town 100 kilometers from the provincial capital of Bukavu. Forces are reported to be engaged in heavy fighting along the main route to Bukavu.
On Candy Crush there, Jennifer. I don't know if you play. I don't play myself, but maybe I should, given its popularity. Its growing popularity. Okay, let's end the show taking a look at how futures are faring up. All of these markets are trading in the green, so a bit of a turnabout in sentiment since where we were on Monday, obviously, when we had that tariff scare. Euro Stoxx futures leading the charge up 0.6%. All eyes today are going to be on jobless claims in the U.S., and we also have Amazon earnings to watch out for. And in the UK, of course, we were just talking about the Bank of England's rate decision, not just about the likely 25 basis point rate cut, but also the signaling ahead and what they have to say about the economy and the direction of travel for further interest rates. So that's going to be key for investors as well. But that is it for futures, and that is it for Horizons at Middle East and Africa. I'm Jumana Bersachi in Dubai with Jennifer Sabazaja in Johannesburg. Stay with us for Daybreak Europe. This is Bloomberg.